In this Tesla stock analysis, we will deal with the question what is so special about Tesla and whether or not those aspects justify the currently insanely high valuation. I hope you enjoy. Tesla Incorporated is an American company with headquarters in Palo Alto, California. Tesla is well known for the development, production and selling of electric vehicles. By doing so, the company generated annual revenues of $24.6 billion in 2019. Currently, Tesla is valued at around $810 billion. We start our analysis by analyzing Tesla's business model. As already mentioned, Tesla designs, develops, manufactures and sells high-performance electric cars as well as energy generation and storage products. Furthermore, Tesla offers several services which are associated to the products. Tesla is the world's first vertically integrated energy company. That means Tesla controls or owns most of its suppliers and retailers. Thereby, the majority of the value chain is within the company itself. Tesla supplies its customers with end-to-end products which cover the generation, storage and usage of renewable energy. Based on this strategy, the retail of Tesla products is directly from the company to the customer through the website or several company-owned retail locations. This completely cuts out the middlemen like car dealers. Tesla plans to significantly improve its infrastructure by building more service centers for maintenance and repair, setting up more supercharger stations for fast, easy and convenient charging, and establishing a mobile roadside assistance technical support. All this is done in order to ease the future spreading of Tesla products by making them more appealing to the customer. Simultaneously, Tesla works on improving the autonomous driving capabilities of its vehicles and reducing customer cost. In order to achieve the latter, Tesla tries to drive down production cost of its products. For all customers who still can't afford a Tesla, the company offers customized financing options. Tesla's business is divided into two segments, automotive and energy generation and storage. The automotive segment obviously includes all vehicle sales as well as the leasing business. Furthermore, it includes warranty and insurance products and after-sale services like maintenance and repair. The energy generation and storage segments includes the development, production and installation of solar energy systems and power storage solutions. 93.8% of Tesla's total revenue derive from the automotive segment. This leaves 6.2% of the revenues, and those self-evidently come from the energy generation and storage segment as well as from services. Apparently, the automotive segment is way more important, hence we will mainly focus on this during our analysis. Tesla offers different models from different vehicle categories in order to cover a broad range of the automotive market and meet various customer expectations. We now take a closer look at some of them, starting with the Model 3, which is a 4-door mid-sized sedan which is designed for an affordable base price to address the mass market. The Model Y is based on the same platform as the Model 3, but is a compact SUV that offers space for up to 7 persons. The Model S is a 4-door full-size sedan which was first released in 2012 and introduces some of Tesla's most iconic features such as the big touchscreen, the autopilot and fast charging. This model addresses the premium market. Model X is a mid-size SUV with the unique falcon wing doors, a panoramic windshield and space for up to 7 persons. In addition to those models, there are some others designed for more specific customer requirements like the Cybertruck or the Roadster. Additionally to all those private vehicles, Tesla has planned the Tesla Semi for commercial use. Within the energy generation and storage segment, there are 3 energy storage products, the Powerwall, Powerpack and Megapack. Powerwall is a rechargeable lithium-ion battery with the capability of storing up to 13.5 kWh designed for private use or small businesses. Powerpack and Megapack are larger integrated storage systems with capabilities of storing up to 232 kWh for the industrial and commercial use. Tesla also offers solar energy systems for the generation of power. Tesla buys most required components like modules and electronic hardware, but a few parts are built by Tesla itself. For all the parts that are bought, Tesla has multiple sources to ensure supply and competitive prices. Tesla creates value to the customer with their top-tier electric vehicles that distinguish themselves by their technology, futuristic design, and easy and convenient usability, especially during the charging process. Tesla offers this value within most price categories of the automotive market. Tesla uses their technical expertise regarding batteries to offer products beside the automotive market. Both business segments are monetized through product sales and lease options. As I mentioned earlier, Tesla is a vertically integrated company which strives to control most parts of the value chain it operates in. We will now take a closer look at Tesla's cost structure and margins. The largest cost of Tesla are the cost of goods sold. The gross margin of the automotive sales business is 20.1% and the gross margin of the automotive leasing business is way higher at 47.2%. But the leasing business only accounts for 4.2% of Tesla's total automotive revenues. The gross margin of the energy generation and storage segment is 12.4%, and the gross margin of all services is minus 24.4%. The consolidated gross margin of all segments is 16.5%. The operating expenses consist mainly of research and development, as well as selling, administrative and general expenses. After these expenses, Tesla achieves an operating margin of minus 0.3%, and after finance cost, it has a net margin of minus 3.2%. Those are all margins of the fiscal year 2019. The consolidated gross margin of Tesla in the first 3 quarters of fiscal year 2020 was 22%, which is a significant improvement. The operating margin finally reached positive figures and sits now at 6.8%. Even the net margin is positive as well, with 2.7%. So after all, Tesla has finally reached profitability. Now we take a look at Tesla's competition and its position within the markets. But before we do that, we ask you to hit that subscribe button if you like our videos and appreciate our work. Thank you very much. The market for electric vehicles is highly competitive. To assess Tesla's position in the market, we at first take a look at the market share by company in the global plug-in electric vehicle market. Tesla leads this market with a total market share of 18%, followed by Volkswagen with a market share of 12.6%. After this comes the Renault-Nissan-Mitsubishi alliance with 9.4%, Hyundai with 7% and BMW with 6.9%, BYD with 6.1% and Volvo with 3.7%, General Motors with 3.4% and finally SAIC with 3.1%. It is of course great to be the market leader, and generally speaking, a market share of 18% within the global automotive market is quite an achievement. If we take a look at the market share by company in the entire automotive industry, combustion engines included, we find that the leader is Toyota with a market share of 10.2%, followed by Volkswagen and Ford with 7.6% and 5.6% respectively. This means that Tesla is leading the electric vehicle market with a higher market share and by a substantially higher margin than Toyota leads the entire automotive market. If we take a look into more specific markets, beginning with the United States as Tesla's market of origin, we find that Tesla totally dominates the US market. Of all delivered electric vehicles in 2019, 190,000 came from Tesla. The closest pursuer was Toyota with 24,000 units sold, followed by Chevrolet with 21,000 and Nissan and BMW with 12,000 each. The largest local market for electric vehicles is China, due to the fact that electric vehicles are highly subsidized by the government because of smog issues in large cities. In China, there are many native electric vehicle manufacturers like BYD, SAIC, BAIC and NIO. The Chinese market is led by BYD with 60,000 vehicle sales in the first half of 2020. Tesla comes second with 50,000 sales, followed by Volkswagen with 30,000 sales. After Volkswagen comes SAIC and General Motors with 24,000 and 22,000 sales respectively. We can conclude that Tesla is leading globally, dominates the US market and even has a decent position in the largest local market, although it's a foreign market with many native competitors. This is a quite good position to be in. One important factor that much likely led to this position is the brand Tesla. Tesla has established itself as a premium electric vehicle manufacturer very early and skimmed the market by introducing premium products such as the Model S first, and afterwards introducing less expensive alternatives like the Model 3. But the number one specialty about the brand Tesla is Elon Musk. He inspires people with his visions and appearances, thereby creating a large base of people who love the brand and want to become customers as well as shareholders. You could assume that Tesla also distinguishes itself from its competitors by patents on innovative technology. But in 2014, Elon Musk declared all Tesla patents as open source, thereby permitting every car manufacturer in the world to use Tesla's technologies. This theoretically enables them to achieve at least the technical progress Tesla has achieved. This move is highly unconventional because almost every company in the world strives to create technical advantages and protect them with patents, and Tesla is just giving it away. Back in the day, Elon Musk got interviewed by Leslie Stahl in 60 Minutes and was asked why he did this. He answered that if somebody uses Tesla patents to build a better electric vehicle than Tesla does, it is bad for Tesla, but it is sure good for humanity. Moments like this show the spirit in which Elon Musk approaches his ventures. And while it might not have been the most clever decision to open source all patents from a competitive point of view, it were actions like this that created the brand and the phenomenon Tesla and thereby led to the position Tesla is in today. We will now take a closer look at Tesla's extraordinary management. I guess everybody of you is pretty familiar with who Elon Musk is. Nevertheless, I want to give you some brief information about his person. Musk holds a Bachelor of Science in Physics and a Bachelor of Arts in Economics. In 1995, he founded his first company called Zip2 together with his brother. 4 years later, in 1999, they sold it for $307 million. Directly afterwards, he founded X.com, which was an online payment provider that merged with the competitor Confinity in 2000. Confinity's product at that time was the online payment service PayPal we all use today. This company was sold to eBay in 2002 for $1.5 billion. The same year, Elon founded SpaceX, and since 2004 he is involved in Tesla. Musk owns approximately 21% of Tesla shares and therefore of course is interested in the shareholder value. Not long ago he announced to liquidate all assets apart from Tesla and SpaceX shares, which shows his deep commitment towards these companies. Musk is a visionary who has technical as well as economical education and is interested in the shareholder value with a strong commitment towards the company. In my opinion, these are all aspects that indicate a high likelihood of Tesla succeeding, particularly because Musk has already proved his capabilities of running and growing a thriving business. We will now analyze how effectively Tesla's capital is utilized. The asset structure of Tesla is 1.1, meaning that the non-current assets are 1.1 times as much as the current assets. This is a decent figure. Tesla has very little goodwill, which of course is good. The capital turnover ratio is 0.54, which is the same as NIO's. The capital turnover ratios of Volkswagen and BMW are close by, yet a little lower, with 0.48 and 0.46 respectively. How does Tesla handle investment and dividend policies? Tesla invests 5.5% of the revenue in research and development, which in my opinion could be higher. And of course, Tesla is not paying any dividends. We now proceed to the probably most interesting aspect of our analysis, which is Tesla's past growth. In the past 10 years, revenues grew at an average rate of 71.5% per annum, and in the past 5 years, revenues grew at an average rate of 50.4% per annum. In the past 3 years, this figure was at 52%, which means that growth is stabilizing at around 50%, which overall is an excellent growth rate. The first 9-month revenues in 2020 were up 20.9% year over year. This significantly slower growth is obviously because of the pandemic, and considering that the first 3-quarter revenues of Ford were down 21.5% year over year, and those of Volkswagen were down 16.7%, Tesla is doing great compared to the conventional automotive industry. Before evaluating the factors of influence concerning the future development of Tesla's business, we take a quick look at the financial condition using some important liquidity and profitability ratios. The liquidity of Tesla is sufficient with a current ratio of 1.63 and a cash ratio of 1.09. The profitability is weak with a return on assets of 1.7% and a return on equity of 4.7%. The equity ratio is currently 35% and the interest coverage ratio is just 2.8. The first coverage ratio is 0.67 and therefore too small as well. Overall, Tesla is not really financially sound. But if Tesla can improve its margins in the coming years the way it plans to do, those figures will improve significantly. We now move on to the factors of influence, beginning with the overall outlook for the market Tesla operates in. In the past couple years, the electric vehicle market recorded a significant growth due to climate change. I think it's safe to assume that this trend continues because electric vehicles develop further and lose more and more of their disadvantages compared with combustion engines. Analysts expect the battery electric vehicle market to grow at a compound annual growth rate of 29% till 2027. As the biggest provider in this market, Tesla will surely participate in this growth. An increase in interest rates would damage Tesla severely due to their quite weak financial condition and especially the interest coverage ratio of just 2.8. But as already mentioned, it is quite likely that margins are going to improve each year for the next couple years. And the Federal Reserve announced that they were not thinking about raising interest rates before 2023, which would give Tesla some time to improve margins before being hit by higher interest rates. Within the competition, Tesla holds a promising position as we discussed earlier. But as a car manufacturer, Tesla has a cyclical business, although they are taking the current crisis very well. We can conclude that Tesla has a great outlook for the future, which is of course reflected by the current valuation. The revenue multiple is currently around 33 and the PE ratio, with my EPS projections for 2020 of $0.53 and a current stock price of $850 is insanely high at roughly 1,600. The price to book value is approximately 50, which is of course extremely high as well. But there are some electric vehicle manufacturers that are priced even higher. NIO, for example, is valued at a revenue multiple of 68, which is nuts considering NIO isn't profitable, does not have such a strong brand as Tesla, and has way less market share. Now we will use the discounted cash flow method to determine in what period of time an investment in Tesla amortizes itself out of the operating business. In order to do so, we need the price of the stock, which is currently $850. Then we need the initial EPS, which is $0.53. We need the growth rate of the EPS. Therefore, we use 50%. It is the past annual growth of the past couple years. Before that, the growth was even higher, but the expected compound growth rate of the electric vehicle market is significantly lower. So we think 50% is a somewhat realistic figure. We also make the assumption that this growth is constant, therefore the outcome of our calculation should be viewed as rather optimistic. We discount all future cash flows with Tesla weighted average cost of capital that are currently 14.2%. Under these assumptions, it takes Tesla 22 years to amortize an investment you would make today. In our opinion, this is way too long. Therefore, we regard Tesla as overpriced and don't buy it, although we really like the company. Thanks for watching and hopefully till next time, Tristan and Charles of Stock Simply Clever.